Working on the idea of break-even analysis. I'm going to show you what it means, but we'll show an example of how to calculate the break-even point. Hey, if you're new, my name's Jeff from Finally Learn, where I teach all these financial skills: accounting, finance, Excel. So join us if this is helpful for you. Now, cost, volume, profit analysis, I've got a full playlist on this, and we have break-even analysis as one of the topics in cost, volume, profit. There's also things like target profit and target profit margin and margin of safety. So all those relate to this cost, volume, profit. What happens to our cost and our profit if our volume goes up or down or whatever? So we're specifically talking about the break-even point. So what is the break-even point? It's the point where our revenues equal our cost. It's the point where we have zero profit. Now, we're trying to avoid a loss. We're not really excited about having zero profit. We would like to have more profit, but we want to avoid a loss. So let's just have a simple example and show how this works. So for the Orlando company, we have a sales price of $90, and our variable cost per unit is $61.20, and our fixed cost total is $40,320. So we're going to use two formulas to calculate break-even. One is called break-even in units. So it's our fixed cost divided by our contribution margin per unit. And our break-even in sales is fixed cost divided by contribution margin percentage. Now, one thing we want to do, if we get this information, it's very helpful to go ahead and lay out exactly what our per unit numbers are and our percentages. So our sales price is going to be $90, and our variable cost is $61.20, all given. I'm just going to use formulas so that way we can change the numbers and do a little what-if analysis. That's important. And so therefore 90 minus $61.20 is going to be $28.80. So we're making, on each item, we're making a contribution margin. Because we have that fixed cost, we got to cover that fixed cost, and we do it at $28.80 each time. Now, percentages, everything's going to be divided. All three of these things are going to be divided by 90. Well, I'm not going to divide by 90, so it's just going to be the 100%. And I've already formatted it for percentages here. And then 61.20 divided by the 90 is going to be 68%. And then 28.80 divided by the 90 is going to be 32%. So you can say, well, what is this company's contribution margin? Well, per unit it's 28.80, but as a percentage of dollars, it's 32%. So both are important, and you might want to think of it both ways. That really helps you understand if you kind of do it backwards and forwards. So to get break-even in units, how many do we have to sell? Do we have to sell 100 or 1,000 or 500? How many units do we have to sell so we have zero profit, so we avoid a loss? So our fixed costs are $40,320, and our contribution margin per unit is $28.80. I've already formatted this for numbers here, so it's going to be 40,000 divided by the 28.80, and that's going to be 1,400. We've got to sell 1,400. Now, if our plan was only to sell 800, then we want to know, hey, we're going to lose money, and so therefore we've got to sell more, we've got to reduce our cost or something like that. We need to figure out a way to make a profit. We want to avoid this loss. Well, what is our break-even in sales dollars? Well, it's going to be the 1,400 times 90. Or we can just multiply that, calculate it rather, directly. So it's the 40,320 divided by the percentage, the contribution margin percentage of 32%. And we have 40,000 divided by 32,000. I've already formatted for dollars. So it's $126,000 of sales. And then you get the advantage of avoiding a loss, right? You've got to do a lot to avoid that loss because you have a fixed cost of $40,320. All right, so let's do an income statement to kind of prove this. So if we prove that we can sell 1,400, right? Well, our 1,400 times the $90, that's $126,000. I know I have that already, but I'm going to use that, and we can change the initial numbers and see how it works. So what is our variable cost? Well, it's 1,400 times our variable cost is 6,120. So our contribution margin is 126 minus the 85,000, and we're at 40,320. Does that number look familiar? Yes, that's our fixed cost. Our fixed cost here, I can just use this fixed cost right there. And so therefore we have achieved zero profit. So you've got to sell 1,400, 1,400, or $126,000 to achieve zero profit. Well, we can do a little what if. What if our fixed cost goes down? Let's say it's 30,000. Well, we only have to sell 1,042 to achieve break even, or 93,750 is our total sales. Also, since we have this all built, let's go back to our original numbers. We could change this. Well, what if we could sell 1,500? Well, then we have a little profit of 2,880, and so therefore the volume goes up, our profit goes up. Let's make this 2,000, then we can achieve a $17,000 profit. So break-even analysis is a part of cost, volume, profit, and what happens to our cost and our profit if our volume goes up or down or whatever. Hey, thanks for watching. We'll see you on the next video.